0.9% monthly decline in bank credit to 22.5 trillion naira, and a 12.6% shortage in federal collective revenues when compared to the 2013 budget are among the disturbing data in the central bank's monthly economic report for May. And to discuss the report and what it portends for the economy going forward, I'm joined by Bismarck Rwani, CEO of Financial Derivatives, and Charles Mordi, a Director of Research at Nigeria's Central Bank. He'll be joining us on the line from Abuja. Bismarck, thank you so much for joining us. Thank you, Charles, for staying on the line. I want to start with you, Bismarck, and your thoughts about some of the worrying trends we're seeing. I think the biggest one will be government revenues. And the interesting thing is that, like I read at the top of the show, it seems things are beginning to change, at least for June. We're seeing revenues, at least June revenues by the Accountant General, up to 863 billion naira.
Yes.
So your thoughts about, on the revenue side, the key concerns you have, or do you think we're in a good place right now?
I don't think we're in a dangerous spot, but it calls for caution. And monetary policy makers usually try to stabilize things and watch out for the difference between the monetary conditions and the monetary policy. So I don't think it calls for concern, it just calls for closer observation.
Right. I want to bring you, Charles, into the discussion here, and thank you for joining us. So
yeah, thank you.
It will be interesting to see how the central bank reacts to some of this data. Beyond the revenues and what that could mean for monetary policies, of course, we have to keep a close eye on the exchange rate and reserves. We're seeing, for instance, FX demand be at 2.5 billion naira. That's up about 6% compared to the demand we saw in April. And many people think that trend is likely to continue in June and even going forward over the rest of the year. Are you concerned that we could see that trend continue, or do you think this is more of a blip in terms of the increase in demand?
Yeah, the increase in demand at this time of the year is not unusual for us. If you've looked at data for the last, since 2011, about this time of the year, we usually experience this demand pressure, largely because of dividend payments and other obligations that have to be made about this time of the year. Yeah, indeed, we looked at the numbers, and what we are seeing actually seems to have been exaggerated in terms of the outflow. And looking at the fundamentals, actually, there's no reason for the panic that probably resulted in the high demand we're seeing. But like I said, it's more of a seasonal pattern.
Right.
Actually, it's something we see that is going to continue in the future.
Well, you say there's no need for panic, but then a lot of people will point to the external reserves. They haven't grown. In fact, they've actually come down. If you look at the last 1 or 2 months, they seem to have stabilized between 47 and 49 billion dollars. But then many people say that the trend seems to be southwards, especially if we begin to see oil prices fall.
Yeah, to a large extent, you are correct in terms of the level of reserves. We've seen them come down, and also we've seen inflows, reduced. But looking at the numbers we have in our database, does not seem to suggest that the trend is likely to continue. Like I said, looking at the last 2 years, looking at the historical numbers, and we've experienced this in the last 2 years, and we believe that, yes, there might be danger signals, particularly with respect to the oil price. But so far, so good. Oil prices have not really come down below 100, and the projections from the key forecasters out there globally does not suggest that anytime soon it's going to fall below $100.
All right.
Well, I have a question for you, Charles. In the last 2 weeks, we saw the central bank ask for some forward quotes. What are you seeing in the forward quotes? Because essentially, if you have a forward quote, it should take away the speculative demand for the dollars in the market, and therefore allow the spot rate to actually stabilize.
Yeah.
Are you seeing any indication that this is the case?
Surprisingly, it's not as if the issue of the forward market has always been there. And the banks or the authorized dealers are aware of the forward market. But surprisingly, for some time now, they've not been coming, largely because there has been significant supply of foreign exchange from autonomous sources. We've only seen 1 or 2 deals lately, precisely, let me say sometime last week, in the forward market. We believe because the essence of the forward market is for people to get locked in at the current rate.
Yes.
But we believe that maybe with the emerging trend, that the interest in the forward market will
pick up.
We again, come up.
Okay, Charles, if we can move to the issue of credit, credits has fallen month on month, at least that's what the data suggests. Still pretty high, but is this something that concerns the central bank, the fact that we're seeing a decline?
No, of course, the central bank has always been at the forefront of, being concerned about credit to the economy, particularly credit to the real sector. But the point we have to make there, we cannot. I know there have been suggestions out there that probably we should go back to the era of control and directing banks to give credit to specific sectors. But all we're trying to do is to put in measures that will actually, encourage banks to lend to the real sector. But let me add to that what central bank alone cannot address the problem confronting the economy, particularly as far as the infrastructure side, is concerned. There has to be reforms in other sectors for the banks to be reassured that the risk elements that make them to shy away from lending to the real sector are at least minimized. And what we have done with respect to the agri sector, as far as the NESA is concerned, is to de-risk that sector so that banks can lend to that sector. If that can be replicated across the other sectors of the economy that the banks perceived as being risky, particularly the SMEs, then we'll begin to see credit flow to those sectors of the economy.
The question of credit and the relationship between credit and interest rates. Some are of the view that the current rates of interest, many people in the real sector are actually accessing credit outside of Nigeria because relatively it's cheaper to do that if you can hedge the exchange rate risk. Would it be an interesting development if we see interest rates come down marginally and then we begin to see the demand for credit begin to grow?
Central bank itself is even concerned about the current rate of that's lending rates. It's not as if we are not aware of it, but there are so many parameters that go into the computation of interest rates. Why not defending the banks? Like I said, there are other cost elements that go into determining what the lending rates will be. And once we begin to address some of those challenges, we may begin to see rates come down. I mean, part of what central bank is doing to reduce the cost of funds to bank is this shared services project that we have going on. So that's to reduce the cost of intermediation.
Yes.
And these are the things, I mean, you talk of infrastructure, you open a branch, you have to provide literally everything, light, water, you name it. So these are costs that the banks also, some of the administrative costs that they build into their interest rate determination. Once some of these costs are removed, or at least reduced significantly, we begin to see a decline in lending rates.
All right, Charles, if I can just end up on this point.
To carry that further, because sometimes when we talk about interest rate, people tend to focus more on the lending part. But you talk of what of depositors that put their funds in the banks. They also need to be properly remunerated and encouraged. So we're talking about lending rates. You also need to look at deposit rates.
All right, Charles, I really need to wrap up, so you need to make this pretty quick. Looking at the data you're seeing so far, what are your broad expectations for economic growth in the second half? Are you more optimistic than you were saying in the first half of 2013, or are you more cautious?
Generally, we are more cautious to the extent that we still have a lot of challenges in some parts of the country, security challenges in the northern part of the country, the agri areas. It's still a challenge, but we believe we are not, while we may not attain the same growth rate as we did last year, but we believe that the growth rate will still be robust for 2013. And I mean, the IMF, if you listen to their latest revision, is also projecting Nigeria to be one of the fastest growing in the continent.